Yeah, it looks like the debut of new CEOs is a little bit of a jinx for the private hospital operators. New CEO comes in and the stock takes a tank and joins Healthscope in the ER, where the stock sold off more than 5% on the back of its earnings result. The result itself, it was actually quite solid. It was actually in line with the guidance and our expectations. Underlying profit up 13%, really driven by really strong growth in its domestic business. Now, remind you, the domestic business is about 55% of this company's underlying profit. It was up nearly 13%. So you can look at that and think, well, 13% growth, 30% domestic business. That means the rest of the world ain't doing too well, actually flat. Local currency is less than 1% growth, but on a reported basis, it's actually down 9%. But what really spooked the market outside of that was really the bit softer outlook. And now we flagged this before, just like CSL. The consensus had really run up. Expectations were a little lofty. Management reported looking for 8 to 9% underlying profit growth. That was 2 points below expectations, bang in line with what we're expecting at 9%. Going into the result, and rest of the world headwinds are increasing. Now, we also flagged this going into this result as well. And while it is good to see domestic strength in that, the domestic business strength, very well-known industry fluctuations that have been happening to the industry. They seem to be more resilient than other companies, aka Healthscope in this regard. The management flagged that resilience is really due to a number of things: portfolio scale, geographic diversification, and more balanced case and patient mix. Now, I would agree with some of those, but the real question you have to ask yourself is how resilient is resilient? I mean it because if you look at the first half results, you see the domestic business actually slowed down 370 basis points on the top line. Its EBIT margins contracted 175 bips to 13.2%, much more so than I would typically see with seasonality, which does run through the domestic business. And while acknowledging it's very difficult to compare apples to apples with Ramsay and Healthscope, if you do look at those two on a half-over-half basis, you actually will see that Ramsay actually deteriorated more than Healthscope on revenue, on EBIT, and on margin lines. I'm happy to take that offline because it's a little more minutia there. I'm happy to go through. But taking that with the rest of the world headwinds, they are increasing in the UK and France. Now remember, this is 45% of this base business as well. It's really calling for the base business to really support the rest of the world market, and growth obviously is slowing. So don't get me wrong, we are confident in the base business, and I'm saying it's falling off a cliff here. But we see no changes to the supportive, underlying, unwavering, I would say, demand fundamentals. I've talked about it ad nauseum, the aging demographics, us getting older, obviously, us getting grayer, us getting sicker. Doesn't paint a pretty picture, does it? And we definitely need the private hospital operators in this country. So the demand curve, I think, is unbendable. And I still think it's a really core holding for long-term investors. However, I believe, given the concerns right now, that I did pull it back to a neutral rating. I think the near-term headwinds are hard, and the typical beat and raise cycle that investors pay for the consistency of earnings with Ramsay, it's going to be very difficult this year to get that. So 8 to 10% ain't that bad. It's okay. The stock has derated 3 points to 24 times my new earnings on a forward-looking basis. That's okay. 10% growing. It seems okay. It seems reasonably priced. That's why I moved it back to a neutral. Where would I buy the stock? If it fell a couple more points to around $65, I'll be backing the truck up all day long. The multiple would be therefore in line 22 times with its long-term average, and it looks much more attractive on that basis. But how does it compare to Healthscope? Now, Healthscope seems, I guess it got smashed. It's trading at 17 times forward earnings. What's the growth profile look like? For Ramsay on a 3-year CAGR, it's about 13%, give or take. For Healthscope, I have it about 11 or 12%. Not that much difference, but you're paying 30% less for Healthscope versus Ramsay. Just food for thought. Like I said, Ramsay I still think is a core holding for a lot of investors, a long-term buy and hold. But right now, near term, looking for a better entry point.